All righty. Welcome back to another episode of the I Love Annuities podcast. I am Jeremiah Conger.
And I am Zachary Van Ness. Together we are the AnnuityDudes. And today we are climbing the ladder. And you're doing it with us, literally.
Climbing the ladder. That's right. Today's episode is all about laddering annuities and what it is, why it works, and how it can be a game changer for both growth and guaranteed income in retirement.
Yeah, so whether you're looking to lock in rising interest rates with a product like a multi-year guaranteed annuity, or
MYGA.
create a MYGA, or creating a predictable income stream with a fixed index annuity, laddering can offer a strategic edge.
Ooh, I like that. Strategic edge. That's what we're about. So let's talk about what laddering is. Let's start with those basics. And what does laddering mean, Zach?
Yeah, so simplest terms, laddering is the process of just spreading out the annuity purchases across multiple contracts. And what we're doing with that, we're staggering the maturity date or the income start date, depending upon the annuity type. So instead of putting all of these monies into one annuity all at one time, we're just spreading that out.
That's right. And it's like building rungs on a ladder. Each rung is a separate annuity, time to mature or start at a different point. Did you know that those steps on a ladder were called rungs?
Yeah, you didn't know that?
No, man, I feel really stupid right now.
A rung on a ladder?
No, I didn't know that. Wow. Learn something new every day.
There you go. Yeah. So ultimately what it's really doing is creating some flexibility, potential better rate capture, and more consistent income or reinvestment opportunities over time.
And I think that's really the point of it, right? Is to just really try to create better optionality, better flexibility, but also, trying to optimize the best that we can and some of the uncontrollable things, timing of interest rates and all of that. So let's kick off the MYGA laddering, a powerful tool in today's interest rate environment.
Yeah. So with a multi-year guaranteed annuity or MYGA, it is like a CD structure, right? So it's a CD structure for an insurance company. We've got a locked in fixed rate for a set number of years. So think of a time deposit vehicle, right? So what we're doing, we're depositing X amount of dollars for a specified period of time, anywhere between 2 and 10 years. Most commonly, we'll see a 3, 5, or 7-year strategy.
So let's talk about now where the ladder comes in. So instead of putting $300,000 into a single 5-year MYGA, maybe you could split it into 3 $100,000 MYGAs with varying contract terms. So maybe a 3-year, a 4-year, and a 5-year term.
And what we've seen recently, I've worked with several clients, working with somebody right now where we're taking that approach. And what we're doing is each one matures, we're reinvesting into a new MYGA. So we're structuring these currently for 4, 5, and 6-year terms. It allows you to pivot as time changes and needs change as we enter into retirement or at different stages of retirement. And really the benefits for that MYGA ladder strategy, rate diversification. So we can adjust with the changes in our environment. Liquidity every year or two, depending upon how far stretched in between the maturity dates you are. It also keeps your options open for reallocation. So let's say a MYGA term ends and you say, hey, Zach, at this point, I want a guaranteed lifetime income to begin. We don't have all the eggs in one basket. We've got some optionality that we can flex. It also mitigates the reinvestment risk when we look at that.
And remember, when rates rise, laddering lets you capture higher yields in the future while still earning a good fixed rate today. I have a couple that I worked with a number of years ago up in New Jersey, and the husband was a former CPA, so understands finance and all of those good things. And he was looking to strategically put a MYGA ladder in place. And we did the analysis and basically created a plan where he would invest increments anywhere from 100 to as high as $250,000 annually. And so we started off with 3-year MYGAs and then sprinkled some in there. And then we put in some 5 years and so on and so forth. And I actually just spoke with them today, and they're looking to re-up on one of their original annuities that's now maturing and coming available for renewal. And they're looking to reposition that into a higher rate. So it worked, like the ladder worked. They were able to capture the higher rates then, but because they didn't put all their eggs in that one contract, and they were able to sprinkle it out over several terms and contracts, now they're re-upping and they're able to secure what many would say are some of the higher peak rates that we've seen in annuity products like MYGAs. So we're actually doing that piece of business tomorrow to put that in. So really good opportunity there. It's really big when it comes to, trying to mitigate the interest rate risk that we all face. There's some people that are weary of putting all their eggs in one basket for a longer term because they want to be able to take advantage of higher rates in the future. And then there's the other side of that coin where some people are like, hey, these are the highest rates we've seen in a long time, and I want to lock these in for a longer period of time. That's usually the side that I lean towards is right now, especially is looking at rates today. And, I believe that they're pretty much as high as they're going to get for a little while now.
Yeah.
I think it's smart to find maybe an opportunity to lock it in for a longer term. I just helped a client, I don't know, almost a year ago now, but they locked in over 6% fixed rate guarantee for 10 years. And I think that's pretty wise in my
Great.
opinion.
Yeah. Yeah. And we'll see that, it's funny because I talked to a gentleman today. Shout out Rob. Rob's a listener. Robbie. So we had talked about that a little bit and mentioned that we were recording this today, but when we're looking at the growth opportunity for that annuity, we've got some guarantees there. We've got a ladder strategy with a MYGA. Also have a ladder strategy that we can look at for an income, right? So for an income ladder and using a fixed indexed annuity, which is something that we've used quite often. I know I use it recently for a client. We've looked at one recently for another client. So just a consideration when we're making that planning.
For sure. So here's how it works when we're looking at fixed indexed annuity ladders. Instead of buying one big fixed indexed annuity with income starting immediately or maybe a few years out in a deferral, you could buy several fixed indexed annuities with staggered income start dates, like maybe a 3-year. The first one starts on the income, and then the second one, you activate the income rider in year 5, the third one, so on and so forth. So it's really about trying to determine what your overall objectives and goals are, but then using this laddering approach as a way to optimize your income and do so leveraging the guarantees in those income rider contracts. Those guarantees in the income rider contracts are so valuable because there's nowhere else you can find guaranteed roll-up rates in that 7 to 8% or higher sometimes range. And by leveraging those guarantees, you can strategically grow your future income without having any dictation by the markets or any of the other uncontrollables.
Yeah. So one of the things that comes up frequently in our conversations now, I know for me, is the conversation around inflation. And this is one of those strategies that can be really exercised in. So really what it's doing with this approach of laddering the income, it gives an increasing income guarantee as each annuity kicks in. So it can really help in that concern around inflation and where these can be utilized and starting an income further down the road. And it also allows the fixed index annuity to defer for longer, accumulate more income as it continues to grow for those future payments, whether that's for inflation, whether that's just, things are going to change in a couple of years. Maybe the income is going away. Maybe you're working part-time and you want to shift out of that position.
Yeah, that's obviously a really good opportunity if you have concerns around your annuity income and inflation. In addition to that, I think when it comes to looking at annuities for guaranteed income, why wouldn't you want to have the ability to address future income needs on a guaranteed basis? So maybe what you can do is look at, hey, right now I know I'm going to be retiring in 2 or 3 years or whatever that time frame may be. Maybe you're retiring now and you say, hey, you know what? I want to go ahead and get my essential living expenses covered between Social Security, a pension if you have one still, and then the rest from that income annuity. That's a great thing to do. And that is what you should do if you're looking to provide a foundation of guaranteed lifetime income to support those essential living expenses and ultimately sustain your lifestyle. But then what you can do is take another portion of assets if you have some in addition to that, which you should. And then you can sprinkle them out into future deferments with those fixed indexed annuities. And what that's going to ultimately do is give you the optionality and the flexibility that if or when you need additional income because of inflation or because of a change in your lifestyle in some sort, you can have these future contracts growing on a guaranteed basis so that you know exactly. I think that's the key word, is knowing exactly how much they're going to be when you need them. And you can even get really fancy, if you will, when it comes to the strategy. And instead of putting in bigger amounts of these premiums, instead of doing like 150 or 200,000 and sprinkling them, you could do even smaller increments like 50,000 or 100,000. And what that does is then allows you to have all these separate contracts that are going to grow guaranteed. And let's say you get 7 years down the road and you're like, hey, you know what? We had a cost of living increase because of, I don't know, maybe you needed to put a new roof on your house, and you have expenses that have been added to your bottom line that you didn't have 7 years ago. And if that's the case, you now have all of these other contracts that are just sitting over in your tool belt, and they can be there for that event. So you can go over and say, hey, look, I've got these $50,000 increment guaranteed income annuities, and you can activate one of them, two of them, three of them. I don't know, however many you need. And then if you have several that you don't activate, those can continue to defer out into the future and still continue capturing those guaranteed income rider roll up rates so that your income is just going to be higher and growing and pacing inflation above inflation in most cases, so that you have those there available for you in any type of rainy day that may come.
Yeah. Yeah. And I've found, just in reviewing these with clients, sometimes it's a shock, a reaction of shock that they can even utilize it in that function, right? So oftentimes it's, oh, I thought I could just put everything into one annuity. I didn't think I could do multiple. And the question that comes up often when we're talking about that strategy is, will it produce the same income amount? If I decided to start, let's say, two at the same time, as opposed to putting it all into one and starting at one time. Now, I like the approach because it allows somebody the flexibility to start all of that income at once or defer a piece of it for a longer period of time. And the value that you get from that is, if you break these off into two policies, it's still going to produce the same income amount if you choose to start it at once.
Yeah, and I think also there's other added benefits in breaking them up into separate policies, and they can even be separate carriers, and that's where the added benefit comes in, is now you're mitigating carrier risk and parity risk that's associated with one carrier. So you're mitigating that risk of financial insolvency if one particular carrier had an issue. Well, at least the whole bulk of your money that you were planning for income isn't affected by that. In addition, being strategic about the premium amounts given the, whatever specific state you may reside in, you can make sure that those premium amounts are under the limit for the guarantee insurance association, so that your premiums are protected across multiple insurers and backed by that guarantee association for that. So there's ways to really get strategic there and mitigate multiple risks, and also give you a ton of optionality and flexibility in the future for future income needs. I think we should probably take an example, a look at an example here, Zach, on how we would maybe possibly look at helping somebody with this. What do you think?
Yeah, I love that. Yeah. And we see
All
it
right.
every day, but it's be a great tool to share.
All right, let me go ahead and share my screen here.
While you're doing that, I got to feed this dog. He's just scratching at me. Hang on a sec.
You shouldn't refer to your wife like that, Zach.
Oh, man.
We might have to edit that one out. All right. We'll wait for Zach to come back here, but while he's coming back, I will narrate exactly what we are looking at. So here is our annuity calculator tool that we use to help clients make better annuity buying decisions. It also helps us understand what's available on the independent annuity marketplace, so that we can ultimately help our prospects and clients find the right annuity for their situation. So here we have it, where we have the state of Florida selected, which is our headquarters. For those that don't know, we do service clients in all 50 states. We are licensed in all states. So we can help anybody, doesn't matter where you're located, and help you put these plans in place. We're looking at a 60-year-old male looking at $100,000 premium. What we will look at first, let's assume that this person is wanting to secure their essential living expenses with guaranteed income across Social Security, pensions, and annuities. And let's say that they're initially looking at putting in $250 to get that foundation of income solidified when they retire. This person's looking to retire in 5 years, so activating the income stream at age 65. We're looking at the monthly income ranked chronologically highest to lowest according to the carrier, and who will provide the highest income on a monthly basis contractually. So we'll see Clear Spring comes in number one at $22.81. So let's assume that this person, when they did the income gap analysis, we determined that they had a need of $2,281 a month that they would lean on from the annuity to help solidify that foundation for their essential living expenses and lifestyle sustainment out of the gate at retirement. So let's say they secure this, put this $250 in place, and we're able to now fill that gap, and they have exactly how much income they'll need to sustain their lifestyle at age 65 once they retire and hang up the gloves. Now, if somebody was interested in addressing inflation or future rainy day events, or just a general need of more income at some point in the future, what we could do is, say we plan with a total of $500,000, and the initial $250 is put in place to secure that foundation of income, but then we want to sprinkle the remaining $250 out over multiple contracts and staggered out into the future, leveraging these income rider contracts. What we can then do is take 500,000 or 250,000 that's remaining of their overall 500,000 that was earmarked for the annuities and current income or future income and further future income, if you will. And we want to break that up into 5 contracts of $50,000 premium increments. So what we would do is we would come in here, put in 50,000, and now we would start to look at future income. So if you look at $456 a month, well, let's take a look. So $456 a month added to that 2281, that's a 19 or almost 20%. It is basically 20% increase in income. So that's an inflation hedge. I mean, that's the way that you would want to look at it is, hey, I can add 20% more to my $2,281 a month from my initial annuity. Well, let's say he wants to put that in in place in 7 years, activate that in 7 years. That's just going to go up. And the reason why that income is going up is because of the contractual guarantees that the income rider is providing. In this case, this ClearSpring annuity is offering an 8% compounded roll-up rate in addition to the one-time income-based bonus of 8%. And what's neat is that within this contract, this person can defer that income from that annuity for up to 12 years and capture 8% every year of deferral. So if we look at this deferral screen, we'll see how that works. So you'll see the benefit base and how it continues to increase each year when that 8% compounded roll-up rate is added. Now,
Right.
so
To
that's
be clear,
that's only one of the 5 contracts, right, that we could put in place of $50,000 increments. Let's say we do a second contract, right, Zach? And let's say we push that out 10 years.
Yeah, to be clear, that compound roll-up rate is crediting the income calculation. So it's not a direct credit to the account value.
That's a good call out. And that, in other words, it's not withdrawable as a lump sum. Let's say you get
Right.
into this and you're like, oh, I love the 8%, but I don't want the income. I just want to cash it out. That income benefit value is used to determine the lifetime payment. It's not used for any other reason or purpose other than calculating the lifetime payment in the future. If you want to cash out, you can, but you would be cashing out the account value and whatever that's worth at that time, not the income benefit value.
Yep.
So if you want to take another 50,000 and defer it out 10 years, now the income went up to 714. Remember, we can go out 12 years with this. So maybe we do that third contract and we defer out 12 years. So now this person, let's call him Bob, he's going to turn on his initial annuity with 250,000 at age 65. And then at age 67, he's going to get an increase. At age 70, he's going to get an increase. And then at 72, he's going to get an increase. But remember, we have one more. So let's say we want to go out to 15 years on that final fourth contract of $50,000. Well, maybe it's a different company that comes in now because remember that ClearSpring only had a deferral period of 12 years to maximize 8%. Well, now Nationwide comes in number 1 at 930 in that final fourth contract. So that's one way that we can help you find, the strategy when we deploy those income streams and over time when we activate them, and then which companies and products are going to give you the most optimal guaranteed income based on your age and then those different deferral periods that are staggered out into the future.
Yeah, the big takeaway beyond using this laddering approach is knowing that we don't have to have a set criteria of when these income amounts start, right? So what Jeremiah is displaying here is really we can start these at any point as long as we have a strategy in place. We can begin the income at that time. So as long as we've got a notice of roughly 60 days before you want that income to begin, we can set the groundwork for starting the income for you.
Absolutely. And, there's just a ton of benefits in doing this. It's future peace of mind. That's the way that I look at it. It's being smart and strategic about your future and your future income. And you're doing it on a guaranteed basis with those roll-up rates. You're growing it at something is going to be there and exactly how much it's going to be. In addition to that, if we discuss other benefits, like what if you don't need the income and you don't ever turn it on? Well, guess what? The account value, which is your initial premium, has the ability to earn interest also on a non-guaranteed basis if you allocate to the index strategies that are offered in the contract. You also have a guarantee of principal protection on that money, so there's no downside risk to that. In addition, some of these products, which we've discussed in previous episodes, have enhanced income benefits for long-term care. So maybe you don't need it for income in retirement anymore, but these things have been growing and deferring to then be able to activate the enhanced income benefit for future long-term care needs. So last but not least, if you pass away and you've never, turned these income streams on, that account value is going to have money there and that'll pass on and avoid probate in most cases, and pass on to your designated beneficiaries in the contract. So you just have a ton of peace of mind and future certainty that, hey, I have this if I need it. If I don't use it, I don't lose it, and it passes on and it grows to a degree out into the future. So it's just a really, really well-rounded strategy to help someone optimize their retirement income and future needs.
Yeah, there's options, right? So a lot of these policies will be a 10-year surrender period. Maybe that means that you've got the accessibility to just take it out and shift your plan. So a lot of options that we can look at there. Let's see here. We had talked about this before. Do we want to do a comparison of the MYGA ladder and the fixed index annuity ladder?
Yeah, if you have that visual up, I guess go ahead and share
Well, now I got to get it up.
it.
Aha. Hang on a sec.
Did you feed your dog, by the way?
Yeah, so just an yeah. You're going to owe some drinks for me and Jen after that comment. Hopefully she doesn't listen.
She doesn't listen to your stuff, dude.
No, I'm kidding.
You're starting to lag on your end, by the way.
Yeah, I know it. I know. I knew that was going to happen too. All right. Should be able to see it here in just a
What we're
moment.
doing is pulling up a visual of just the differences and like the intended purpose and things of how a MYGA ladder could be used versus an FIA income ladder.
Yeah. Can you see that?
Yes, sir.
All right, cool. Yeah. So just a better defining, and we'll go from top down with the columns, just defining the features and what we're using it for. So with a MYGA ladder, the purpose behind it is that safe growth and reinvestment, the ability to reinvest into a different product, right? With the feature, it's the rate type that's providing is a fixed rate of interest. So we know exactly what type of return we're getting from it. In terms of liquidity, during that MYGA period, during that 5-year commitment, whatever commitment term you select, oftentimes these products have the accessibility to make withdrawals. It's just a matter of finding the right MYGA that fits your goals. So some will have that capability, some may not. And that's where speaking with an expert will provide you that clarity of what you may be looking for. Inflation hedge, limited because you know exactly what rate you're going to get. So it may not keep with pace of inflation, but it may provide what you're looking for. And it is ideal for conservative savers. So in the world of annuities, I liken this to be probably the more conservative option within an annuity. And it does exactly the job we expect it to do. No surprises, not many bells and whistles, and we know what's coming with it.
Yeah, that's it.
With a fixed income ladder, the purpose for that is that guaranteed income where we can strategize that and space that out over time if we wanted to. The rate type that you're getting, you've got that income rider where the income increases at a guaranteed rate every anniversary date. And the account value is index linked. So based on that index performance for that account value has the ability to increase. With the liquidity, again, that's purpose is that income. You've got the access to it. Once that anniversary date has triggered the increase in income, you can turn it on, at any point. Inflation hedge, you've got a strong inflation hedge here. This, again, is part of what we had talked about in utilizing this product. And it's ideal for the income-focused retiree.
Yeah, that's a good comparison there. So ultimately, if your focus is safety and rate capture, MYGA ladders are your friend. And if you're planning for staggering retirement income, then FIAs with income riders really offer some serious firepower.
Yeah, laddering brings structure to the retirement planning, especially useful in today's uncertain environment. Rising interest rates, longevity risk, sequence of returns, a lot of factors that we consider there.
And by combining growth and income ladders, you can essentially create a customized retirement paycheck strategy that delivers income when it's needed, maintains growth potential, and offers flexibility as life happens and evolves.
Yeah, and remember, really, when it's coming down to is you're not married to just one strategy. So you can ladder the MYGAs into your 60s for growth and ladder fixed index annuities into your 70s for income.
Yeah, you can even kind of use a combination of both too, if you really think about it, in terms of, maybe securing a guaranteed lifetime income annuity, creating that foundation, and then using MYGAs for growth. And you can source the interest as supplemental income off of that growth. So there's multiple ways to do it. It just comes down to, do you want guarantees on income for life? Because if you use that laddered approach with an FIA for income and then a MYGA for growth, and then supplementing the interest as supplemental income, you're still playing the interest rate risk ultimately on the MYGA side of that equation, because we don't know what the rates are going to be out long term into the future. You still kind of have some risk there, but some people like that strategy because you're not burning down any type of principal. You're really just using interest from the MYGA contract as you need it. It kind of gives you the ability to, as you need it, but not always needed. So if you have a year or something that you're like, hey, we need more income because of a trip or something, then you can take it from the MYGA, but then the next year be flexible and say, hey, we don't need it now. Let's let that thing continue to grow and compound.
Yeah. Yeah, we've seen a lot of strategies work, and really from our end of it, in discovering what's important with our clients, that's what allows us to find out what utilities we can use in the annuity space. And just if somebody likes an approach like that, we take a look at it, and we don't throw everything at you at one time. It's a progression of understanding how these annuities can function and where they can add value.
Yeah, absolutely. So let's take a look at what we can do here. So before jumping in, some of the key considerations are definitely going to be carrier ratings, free look periods, right? So knowing that, what your rights are post purchase and how long you have to evaluate that contract or policy. And if something doesn't match up to what you were intending, then we have time to make it right. Also, being aware of the surrender schedules, the type of product you're buying, and what the associated surrender schedule is, and the penalties that might be involved if you were to surrender early. Obviously, if it's an income product, what the income rider costs are. You want to weigh the fees versus the other benefits in those FIAs or those fixed indexed annuities.
Yeah, and really when it's coming down to this, it's working with somebody who has the ability, who can actually model these ladders and evaluate what's important to you, and reviewing these important factors like the carrier rating, what you have access to. Is it important that you have the free withdrawal ability in a MYGA? So we're just comparing apples to apples to make sure that election that you make is the right path for you.
Absolutely. So when it comes to building your own ladder, it all starts with a clear understanding of your objectives and goals, what you're looking to accomplish, what the intended purpose is for the annuity, and if it's an income play, what your income timeline might look like, and then what your liquidity needs might be if it's a MYGA side of things.
Yeah, so some approaches like we had discussed might be using a MYGA ladder to cover early retirement needs and maybe bridge an income source until Social Security begins. Other option might be to deploy a fixed indexed annuity with that lifetime income ladder to create that future guaranteed lifetime income. And then really just keeping a portion liquid for emergencies and opportunities just outside of the annuities.
And absolutely don't forget and leave out the fact that laddering annuities compare beautifully with other strategies like bond ladders, dividend paying stocks, or even some sort of Roth conversion strategy. I mean, it's all about creating a holistic and cohesive plan and using annuities as a tool in combination with the other tools in your tool belt.
Yeah, so really that's going to be a wrap for today on what we've discussed with the ladders and the strategy breakdown. So whether it's growth, income, or both, laddering annuities is one of the smartest tools in retirement toolbox, and we use it pretty regularly in our planning.
So if you're curious on how to build your own personalized ladder, reach out to us. We'd love the opportunity to help educate you and be transparent in the way that we build those and what products and carriers and companies and things that we might consider to ultimately help you make a smarter annuity buying decision. So you can visit our website, or rather in the show notes, if you're interested in finding out more, or maybe you want to speak to one of our senior annuity advisors like Zach here, you can click on the link to schedule a time via Zoom to work with Zach on putting a laddered strategy together. Or maybe if you're not ready yet to speak with somebody from our team and you just want to get a report and some more information about the different annuity types that you might consider for retirement, there'll be a separate link there that you can request to submit your information, and we'll personally tailor an annuity report that'll have all of the highest rates, products, and things to consider so that you can start your process of understanding and lifting ultimately your annuity IQ. But there'll be a separate link there provided to do that. But either way, don't forget to subscribe, give us a thumbs up or a like. If you have a comment or a question, please feel free to do that as well, and we'll get back to you as soon as we can. If you share this episode with someone who's maybe looking for this type of information, it's also greatly appreciated. It helps us reach the masses to ultimately serve our mission, and that is to help people make better annuity buying decisions. And we do that through education, transparency, and trust. So without further ado, we're Zach and Jeremiah. We are who?
The Annuity Dudes.
Dudes. And we'll catch you next time on another episode of the I Love Annuities podcast. Thanks for watching.